Good morning, everybody, and welcome to the Daily Energy Markets podcast. And we have Brent crude oil trading a little bit down this morning, but essentially unchanged, it would appear, with Brent trading at around $90 a barrel and looking a little bit stuck around there since it sort of popped above 93 at the end of last week. So it's somewhat stuck in a downward trend. Let's go to Ole Hansen, Head of Commodity Strategy at Saxo Bank, to kick us off this morning. Ole, where do you think this market is going? It sort of lost its steam from the geopolitical stress and back to fundamentals, which are a little bit sober. Your thoughts?
Good morning, Sean. I think the price action this past couple of weeks speaks very loudly. The markets simply don't know. We are trying on a regular basis to price in some kind of a war premium. So far, it looks like that has been maxed out at around $5. And as soon as we see any news that contradict that, we see that this premium being reduced once again. It just simply shows the market is trying to price in what a disruption would mean in terms of prices, and it also just highlights how difficult it is to trade something that has yet to occur. Because the market right now seems to be settling down somewhat. Demand is softening into the winter months, and that's keeping a lid on the prices. So we're sticking with our outlook for this quarter that Brent is likely to find itself in an 85 to 95 range. I think the only thing that we know for sure right now is that there is a floor in the market. OPEC has fought very hard to defend prices. And that basically means down towards that 80 level in Brent. I'm sure we will find some additional support. So I think that's the only thing we know for certain right now. How high it can go really depends on developments moving on from here. It's getting a little bit of a long answer, but I think all the worries about disruption in the Middle East, I simply don't see that happening. US is not anymore the big customer of the Middle East. That is China. Russia is sending a lot of oil to the region for refining. So it's not in Russia's and China's best interest to see any disruption. So they'll work tooth and nail to avoid that. So I think that we won't see the disruption that the market is so worried about.
Vandana Hari, founder and CEO of Vanda Insights from Singapore. Vanda, I see on your daily note today, Vanda Insights, crude ticks up early due to bargain hunting after slide. There's a bargain out there. Tell us about this bargain you've identified.
Good morning, Sean, and to all our Indian viewers, I'd like to wish a happy Dussehra. It's a festival that celebrates the victory of good over evil, and God knows we need that in today's world.
In large quantities, please.
Yeah. It was okay. The 3% overnight drop that we saw in Brent and WTI might have seemed a bargain opportunity for people who think that the Israel-Hamas situation is still smoldering away and could potentially erupt into something bigger. So I completely agree with Ulla that it's hard for market to decide what exactly it is pricing in. I would say the oil market is flying blind. Between, let's say, zero being no oil and gas supply from the region, production or supply being affected, which is the situation now. Let us remind ourselves to, let's say, 100%, which is give or take 23 million barrels per day of production in that region getting entirely shut in, the worst case scenario, which is almost hard to comprehend. Where in that spectrum do you land your base case scenario? It's just impossible to ascertain that. And as Ulla said, we don't know how the situation. It's in a great flux, the situation. We don't know how it's going to evolve. But I think there's multiple layers of additional challenges for the oil market, because for any given scenario of how the conflict evolves, you have to then try and connect so many dots to how exactly, if at all, it would impact oil and gas supply from the region. So in such a situation, you have little choice. If you are a participant a stakeholder in the oil market, to stay a bit on the long side, I would probably assess the current war premium around $5. It has come down a bit from last week's $92, $93 Brent prices that we saw. But I don't see it disappearing as long as this situation is simmering. And the market will just remain poised to jump in to buy again at any time, the slightest hint of the hostilities becoming worse or widening into the region.
Let's welcome Ahmed Mehdi, Managing Director, Renaissance Energy Advisors and Visiting Fellow at the Oxford Institute for Energy Studies. Ahmed, if we had a Venn diagram with Saudi Arabia in one circle, OPEC Plus in the other circle, and the crisis in Palestine in the other circle, the three of them there, what's in the nexus for you?
Good morning, Sean. So I think that I wouldn't put those categories in that Venn diagram, really. I think that Saudi oil policy is disconnected to a certain extent from, or rather the driver of Saudi oil policy is not necessarily the ongoing geopolitical crisis in the Middle East. I think in terms of where the potential disruption is around US potentially tightening compliance around Iranian exports, but I think that's unlikely. We've seen a little bit of a reshuffling of the sort of the chess pieces on the board with the Venezuela move, but again, I think the consensus there is that while it may relieve a bit of pressure on the sour side of the market, it's not going to compensate for any attempted move against shutting down Iranian exports, which actually, the data showing that, Iran is going to account for this as a second largest source of supply growth this year. So we're talking about an additional, 700,000 barrels a day of exports year on year from Iran. But I think that in a way, those volumes are more determined by Chinese demand rather than any geopolitical situation with regards to the US.
Well, if you look at Chinese demand, obviously, and the point that Ole mentioned earlier, that the West and Europe and America are not really connected with the physical oil supplies out of the region. Of course, there's been some change with some new flows and products going from here into Europe and some LNG. But with most of the crude and products moving east, where is China's appetite to resolve this crisis? We had them join the chorus of Israel has its right to defend itself, which is essentially kind of appears as the consensus statement by the world powers of, I don't want to get involved. Your thoughts on what China's appetite might be, given that any disruption would certainly be knocking on their door?
Yeah, I mean, I think earlier in the year when there was an announcement around China acting as a broker between Saudi and Iran, I think a lot of people actually correctly identified that as an attempt to try and position themselves in a region where there were, where the story for the last several years has been one of uncertainty around the role of the US. There's more competition between these mid-sized regional powers. And I don't think in a way that there was ever any sort of replacement of China taking over the role that the US has taken over in the region. However, I think that my point earlier about Saudi oil policy and how that relates to the next steps is that it's as Ole said, we're moving into a softer balance in the first quarter. We will soon the market will be trading January barrels, so I think that in a way the Saudis will look to be quite cautious around any unwinding, and even with China, I mean, I think the theme of the market since the Russia crisis has been, at no other time has there been such a great menu of crudes for them, including the gray barrels in the market. So the way that Iranian oil trades in China, Venezuelan oil trades in China is very different. So the government, at the end of the day, the Chinese government is always going to be the balancer in chief. So I think that that's an important, consideration that, in terms of direction of the market, it's really about the way the Chinese government policy evolves.
Ole, trying to read where the risk on, risk off appetite is at the moment. We saw the dollar having a pretty robust last month or more, and typically kind of risk off the flight to safety, perhaps. But the oil markets are looking a little bit no drama, Obama, and the equity markets are sort of looking for direction. But the one that seemed to take some sort of upward momentum is the Bitcoin topping $35,000 yesterday for the first time in over a year, 18 months or so. I'm wondering, is that a risk on or a risk off flight to safety for you? How do you interpret the movement of Bitcoin when all the other markets seem to be rather flat pancake?
Oh, you're probably asking the wrong person, Sean. I'm not watching it that closely. Obviously, I'm watching the regulatory debates that's happening in the US, and part of that is right now favoring Bitcoin as an investment, as the possibility of trading it as an ETF becomes greater. So I think that's adding it. But there is obviously something underlying going on as well. We just seen a near $200 rally in gold in 2 weeks. That is not safe haven, all of it. I think it's mostly a lot of that, and that's probably also the reason why we believe that move is going to continue, is the concerns about the US bond market. And I think that's probably where the Bitcoin bid is coming in as well. Bond yields have spiked high in the US. We're seeing some extreme volatility there right now, 5% plus yesterday, and 10 years now we're at 483. Bill Ackman and Mr. Gross been out saying that they covered their short position that potentially helped the market along a bit. But with yields having risen that fast in such a short period of time, there is a risk that something's going to break. There are some extreme unrealized losses on books all over the place, and that basically is the concern. At the same time, the U.S. central bank obviously needs to continue to issue a lot of debt because the U.S. debt situation is not under control. And so I think the Bitcoin rally, the gold rally is all reflection to a certain point what happened in the Middle East. But I think safe haven bits, they come and go, they don't last. But what's happening right now, which could become a big issue, is the worries about this rapid rise in yields around the world and what it means for stability in the bond market. So I think that's basically the main driver there.
Vandana, we had the Chinese government overnight approve 1 trillion yuan in additional sovereign debt issuance as Beijing sort of appears to step up efforts to spur infrastructure spending. Is this the sort of the final, the long anticipated arrival of the China bazooka stimulus?
I'm not sure it is, Sean. I like your word bazooka. I think you've used it in relation to Chinese stimulus almost every time we've talked about it. No, the short answer is I don't think there's going to be a bazooka stimulus from China. Look, the way I look at the Chinese economy, especially from a oil, energy, commodities market perspective, is that it's chugging along. Okay, it's not burst out of the gate with the relaxing of COVID restrictions, and it's not gone into a downward spiral either. I mean, we had huge nervousness around the bankruptcy of Country Garden, other major troubles in behemoths in the property sector in China. Stock markets have gone up and down. But overall, the economy is chugging along. I think that's the best phrase I can find for the country. And if you look at their commodities, especially, let's talk about their oil consumption. Again, it's a bit of mixed signals. So again, on your show, Sean, I've talked quite a bit in recent months about how the macroeconomic data is showing that China is going to it's going to be a very long uphill, rolling the boulder up the hill for China to get momentum into its economy. That's what, all the PMI and export data and so on are telling us. But there's mixed signals still if you look at the crude imports, for instance, right? First 9 months of the year, up 15% year on year. But a couple of things to keep in mind to put that into perspective. So it comes off a small base, relatively small base of 2022. And second, China is exporting more of the crude that it is refining after importing more. China is also moving quite a bit into stockpiles. So Chinese product exports have gone up 55% year on year. I know that sounds like a tremendous figure, but again, from a small base. So China is exporting on average 1.2 million barrels per day, a third of gasoline, distillate, and jet fuel. It has also stockpiled an average of about 700,000 barrels per day of crude. We did see them destocking in July and again in September, which tells you that China remains very, very price sensitive. And I think it has played its hand pretty well by buying up more crude in the first half of the year. Probably they were betting that prices would be higher in the second half, or at least in the fourth quarter of this year. So, just more of the same. I think very little in terms of headlines out of China now excite me, which I would dare say is probably the sentiment overall in the oil market.
Well, it certainly will be interesting, Ahmed, to see where China puts its growth forecast for the new year, as they typically do in December, give that sort of target. But Ahmed, you mentioned in your earlier point that we'll soon be trading January barrels. How do you expect the Saudis and OPEC Plus to navigate that going into the meeting next month, when you have this news on Venezuela, more supply coming from there? Is it possible that the OPEC Plus countries that are part of this supply cutting agreement will actually have to cut more? Your thoughts on the outlook going into the soft first quarter with more barrels from Venezuela, more barrels from, it seems, Libya, Nigeria?
Yeah, so actually just briefly back to the point on China. So I think one thing that's interesting is when you look at the petrochemical feedstocks and the imports around that for this year, and the expansion of petrochemical capacity, just in terms of effectively the new greenfield refineries, and certainly quite a substantial amount of petrochemical capacity is being built, and that's effectively alongside the growth outlook on the macro side. We have to kind of think about what will be the outlook for petchems in the next year or two in the short term, just in terms of where you see low cost facilities being built in China. Their self-sufficiency is going to increase, and effectively their imports of petchem and the derivatives will shrink. So actually, even within Middle East and Asia, there is a bit of margin compression on the petchem side. So that was the story of this year, and so let's see what happens next year with petrochemicals feedstock demand in China, which I think will be an interesting part of the equation. And I think that even if you take a lot of the consensus around 23 balances, I think that we're not talking about very much difference in what the demand growth quarter on quarter and year on year will be, but for 24 the difference is very wide actually. So I think that that's certainly OPEC's own research team versus the IEA, the EIA, and other consulting firms. There's a big difference in that. So that's naturally going to, one has to kind of think about that when assessing the key issue, which is the timing of any potential unwinding of Saudi's cut within the cut, so the 1 million within the OPEC framework, and I don't see that happening in one burst, but effectively, I think that there's more of a phasing of that, and it will be quite reactive based upon where inventories are, but also days of demand cover, and also, you know, that there is typically going to be a softening in Q1. The November meeting will probably be there to assess the inventory and also the situation of other countries, not just the ones you've mentioned, but also the African producers who had their quotas revised, and naturally also the UAE will be adding more barrels to the market as part of that revision. So I think this is all taking place when we look at the geopolitics, the balances. You know, we have to also forget that we are in a backwardated market because of also the about 5 million barrels of spare capacity as well. And that has to be borne in mind. And the question is really like, you know, will the curve actually flatten out into next year, driven by a softer year-on-year demand outlook, but also
maybe the potential to go into contango in the first quarter?
Not contango, no, but a weakening of that curve, a flattening of that curve effectively as a result of the demand side, but more importantly, also potentially slow unwinding of the Saudi cuts into next year.
Let's go to the survey question. Again, it touches on that Bitcoin question I asked earlier, just kind of get some sort of temperature as to whether we have a risk on or risk off appetite in the markets at the moment. Bitcoin is typically a risk on signal. I mean, maybe it's maturing and is now a safe haven, but it has most of its life signaled a risk on appetite in the markets. Is this a shift on this occasion, that it's now some sort of signal flight to safety? There's just $34 trillion printed, is no longer a safe place to be. What are your thoughts? Bitcoin at 35, risk on markets, flight to safety. Ole, I wanted to get your thoughts on all things gas. We just saw another monster deal by Qatar. I mean, if there's anybody winning at the moment, Qatar LNG into Europe did a massive 27-year deal with Shell only a week or so ago, and now one with Eni in Italy. Your thoughts on that, on the deal at a time in which it would appear gas demand in Europe is declining?
Gas demand indeed is declining, but we also obviously need to work out some long-term contracts in order to ensure that we have a stable supply in the years to come, with Russian supply obviously not coming back anytime soon, and perhaps not at all. So I think it's just part of that process that they want to take some of the volatility out of their future costs, and they're doing that by getting these very long deals on board. So it is a reflection of just trying to achieve some kind of stability in both in supply and in price going forward. But you are right, we are seeing a gas market into the winter months here in Europe, which has risen recently. There's been a few supply disruption that to worry about, but there's no doubt that industrial demand in Europe is weak, down probably around 15, but probably more than that percent compared to last year. So that does obviously take.
So it's not efficiency; it's more simply demand destruction from industrial weakness.
Yeah, it takes the peak out of peak out of demand. So we're pricing the February peak contract of peak demand contract months when things could start to get a little bit hairy, is only trading around 6-7 euros above spot. So the market is taking it fairly relaxed at this point in time. But looking out the window, the leaves are still on the trees; they haven't fallen off yet. So it has been a mild autumn, and that obviously does keep gas in storage and delays the peak demand season.
Vandana, the other story that seems to not go away, and at the same token not to arrive at the Armageddon outcome, is the Chinese property market. No bazooka on the stimulus side, as you said, and no collapse on the property side. A slow deflation, perhaps. We're seeing iron ore prices fall, dragged by persistent concerns about China's property sector. Is this the shoe that just will never fall, or is one day we're going to wake up and this is 2007 Lehman scenario, or have the Chinese got this one? What's your read on this slow puncture property crisis in China?
Yeah, it's quite a murky picture, isn't it? But just before I get on to China,
Please.
Sean, if I may just add to the LNG and Europe scenario to Ulla's comments there, is that at least from an Asian perspective, I can tell you that Europe signing more long-term LNG deals is good news for Asian consumers, because this region has suffered massively last year as Europe paid top dollar to pull in a lot of spot LNG from the market. And one of the challenges for this region, countries in this region to plan ahead, 10, 20 years, in terms of energy transition, how much they want to grow their dependence on gas. One of the big challenges is that if Europe will continue sucking in spot LNG for all its needs, then you have a lot of volatility and potentially very high prices in the spot market. So, it's good news. We've seen 3 long-term deals now, and I think Asian consumers are going to be breathing a little bit easier in terms of getting a little more visibility into how this is shaking up. Look, in terms of China, I think what the government is trying to do is getting the population to just get used to a period of relative hardship and as a period of transition, a period of new normal. What I understand is that you were talking earlier about China's GDP growth targets. What I'm hearing increasingly is that the government is going to de-emphasize, whether it does that officially, publicly, remains to be seen, but it's de-emphasizing just growth for the sake of growth. It's going to sort of step back a little bit from having GDP targets and then measuring its performance and success against those targets. I think what they're looking for is more sustainable growth. Increasingly, we see very candid acknowledgement from the government, and we had one again from the National Bureau of Statistics earlier this week when they were announcing the Q3 GDP figure, that speaking very frankly, that it's a difficult time for China, a difficult period of adjustment. They keep reminding their people that the external environment remains difficult. Internally, getting consumption going is going to be difficult for them. So you have to keep all of this in picture. I think when we're looking at China, how to think about it is that it is stepping into a completely new era, which is one of more moderate, modest growth, no major targets, more sustainable growth, moving up there, as Ahmed was just talking about China petchems, right? It's part of the story of the country wanting to move up the value chain of products. So it's just a period of major upheaval, and I think the government needs to, the trickiest part for the government is managing the expectations of the people now going ahead. I think that's what they are going to be focusing on.
Ahmed, last word to you with the survey result, sort of split down the middle here, risk on and flight to safety, and we'll post that on social media. But Ahmed, I wanted to get your insights. Obviously, you watch Iraq very closely, another unresolved. What's the outcome? Is Kurdistan going to get to move its barrels through to Ceyhan anytime soon? It seems that it's on, it's off, it's on. What's your read on that?
Well, actually, about a month or 2 ago, put out a note saying actually don't expect to see the return of the KRG crude anytime soon, to be honest. Because it's also, if you look at actually southern exports from Basra, actually they're actually near the operational capacity. So there's a bit of a swap out, of the crude. I mean, it's complicated in terms of what the prices, there's difference in the prices fetched for northern crude versus southern crude, but effectively you've got a bit of a swap out going on. And also there's actually some of these producers are still not agreeing, even if there is a reopening, on what their cost recovery will look like under any new system. So there's so many factors ongoing at the moment that's sort of preventing and it's quite a complicated picture as well on the new pricing term, the marketing terms, will the trading houses still be involved in term contracts? So it's a big mess. I think that we shouldn't necessarily bake in the return of these volumes for a long time yet, in my view.
Well, we'll wrap it up there with Brent crude oil trading this morning at just a few pennies above $90 on Brent, which many people say is the sweet spot for consumers and producers. Nobody's too upset about that number. Everybody can swing with it. And it's kind of been sitting there on and off for, many weeks now before the recent crisis in Palestine, and it seems that's where it likes to sit when there's no other wind in the storm. So let's see what happens through the week. As always, thank you so much. It's been great to have Ole Hansen from Denmark on the show this morning, and of course our other speakers, Vandana Hari in Singapore and Ahmed Mehdi in London. Really appreciate your insights and look forward to catching up with you all soon again. All the best. Thank you.
Thank you. Bye-bye.
Thank you.
Bye-bye. Have a good day.
Thank you.